Good morning, everyone. Welcome to podcast 19 of the True Potential series. This is a wonderful sunny Friday morning, 29th of May, and I'm joined this morning by colleagues from True Potential Investment Management. We have Jeff Casson, Chief Investment Officer, Chris Leyland, who is Director of Investment Strategy, and Barney Hawkins and Paul Durrans, both investment directors with the firm. Good morning, gentlemen.
Morning. Good morning, everybody.
Paul, this is your first podcast, so would you mind just introducing yourself to our watchers, please?
Yeah, sure. So, as Mark said, my name is Paul Durrans. I've been at the firm for over 7 years now, and been in the investment management department right from the off. But my responsibility lies with managing the growth-aligned fund range, but also managing the Global Managed Fund, which is our auto-enrollment default fund. So I've been with the team for a long time.
Good, thanks, Paul. Jeff, this is your second broadcast of the day. Every morning you shoot a market update, which goes out to both advisors and clients. For those who haven't watched it, please do tune in. But Jeff, could you give us just a little summary of what you said this morning, and then tell us about the week that we've just seen?
Yeah, certainly. So this morning, the podcast focused on a couple of things. One, a theme that we've been running with for a number of days now, probably the past 2 weeks, of increasing sort of political rhetoric and discussion, primarily between the US and China. And that was quite important last night or yesterday, I should say, because asset markets have been performing pretty well yesterday on the equity side. UK, Europe, both up over 1%, but then US was trading very nicely, up over 1% as well, but then sold off into the close. Why was that? President Trump's going to make a statement today on the US relationship with China. So clearly, everybody's very much aware of what happened last year when we had the trade wars ongoing, the impact that had on economic activity, the impact that it had on asset markets. So it'll be very interesting to hear what he's got to say this afternoon when he comes out to say how the US is going to deal with China. There's also an interesting briefing note that's circulating on the internet that just talks about the US relationship with China and how that seems to be evolving and what they're setting out as the agenda. So that's something that if you can take a look at, I'd encourage everybody to have a read, because it does set out, I think, how the US is going to view China going forward. The other thing
Sorry, you used the term rhetoric there. Do you think this is building up to the election, which is coming in November?
I think, yeah, there's an element of that. There's also an element of maybe deflection around how COVID-19 has been handled in the US. And there's quite an interesting dynamic when you look at some of the maps in the US and how COVID-19 cases have evolved, but also I think more importantly how unemployment trends have evolved over the past number of weeks. And it's some of the states that were very strong Trump supporters in the 2016 presidential election race have seen the highest changes in unemployment. So there's an incentive particularly there for him to maybe try and deflect things. And clearly rhetoric with China is an easy way of doing that. Again, it appeals to some of those in his populace, or those Republicans that typically would vote for Trump. So I do think there's a bit of deflection ongoing. I think the ironic thing yesterday around that was his decision to maybe look at the social media companies, which I find that a little ironic, because ultimately they were the things that helped him get elected in 2016, and probably more importantly, it's what his brand of politics is. It's about shooting from the hip and using Twitter as a means of doing that. Which, if he's going to censor them or do something different, well, what medium of communication is he going to use going forward?
Yeah, very interesting. And as things develop, as we head towards November, we've got Biden, who's going to announce his running mate by the 1st of August. And again, a recent Trump tweet was to attack Biden, the picture of him with the mask and the glasses, and Trump just quickly one-liner, looked better. You know, and when he starts attacking that medium, which has served him so well and helped him get elected, the irony is huge on that. For the rest of the week, Jeff, what did we really see happening?
It was a broad continuation of the trend that we've seen over the course of the month, with equity markets continuing to provide sort of the leadership. I think the key thing over the past 7 to 10 days has probably been the story in the background, really, of Europe performing well, Japan performing well, two markets that I suppose don't maybe get the attention that they deserve at times. But I think also, as Barney was pointing out earlier in the week, we've seen really poor economic data from Japan, and actually the market's doing well. So it speaks to the article that we published last week around the link between economic data and equity market performance. At times they are very disconnected, and that's what we've seen, particularly in Japan over the course of this month, with the Japanese market probably the best performing equity market, which is an interesting thing. That's kind of subtly went on in the background. It's not really been discussed. We've all focused on the US. I think the other thing is just a bit of a rotation in the market, with value or cyclical stocks performing better over the course of the past week or so, probably since the middle of May, actually, when you look at some of the charts. Whether that's just another one of these value rotations that's happened over the past number of years and doesn't lead to anything, we'll just have to observe that over the coming weeks. But I think the key thing for us there is it speaks to the theme of diversification, and why it's important to have various different styles within a portfolio, so that you're capturing these changes that happen in the market but are exceptionally difficult to time.
Yeah. And Chris, all of this is good news for the portfolios. Now, Jeff mentioned value as a style. Could you just describe a little bit, please, about the different styles that we use within the portfolios and how that's to the benefit of the investors?
Yeah, absolutely. I think the reality is what Jeff has just mentioned is one word, which is diversification, and that really is key to what we do within the portfolio. So what we definitely don't do is anchor on one single style. And what we have is a group of differing managers, all with differing styles, differing specialisms, all with different ways of working in current market conditions. So if we think about the different styles that we have within the portfolios, arguably we actually have all of the traditional styles that you would find within investment within the portfolios already. So we do have value in there. So if you look over the month, the best performing manager was SEI. So SEI do have a value skew, and that's worked extremely well for them. As well as that, we do have other managers such as, let's say, Close Brothers, who have maybe a little bit more of a growth bias. And actually that's worked well in previous months, where you've seen the leadership from those larger tech companies, particularly in the US, continue and come through. So I think from our perspective, actually within the portfolios, we're incredibly lucky in the sense that you're not just anchoring around one idea, you have all those different styles in there.
And Chris, just basically, what's the difference between value and growth?
Yeah, sorry, that's a good point. So basically, when you look at value, you're looking at stocks that are undervalued. So basically, you're looking at stocks that the stock market is basically pricing at a lower value compared to what is their real worth, in your opinion. So value can quite often be areas that are quite out of fashion, things that people aren't really focusing on right now. And growth is basically your belief that a stock is doing well, it has momentum behind it, and it will continue to do well. So probably the best example of that, things like the big tech companies, which have done exceptionally well. Things like Netflix was the stock of the decade, wasn't it? And there's the belief there that because of their business models, that they will actually continue to do very well.
And how is this translated into portfolio performance over the last month, Chris?
Yeah, I'm really pleased with performance. What you've seen is the balanced portfolio over the month is up around about 4%, just over 4%. All the portfolios have given you strong positive returns. Now, as Jeff said, you've seen really good performance from equity markets. You've seen really good performance as well over the month from the higher risk areas of the bond market. So certainly from my perspective, it's been a great month for returns.
And when we get into the portfolios that have a higher equity content, I guess we're 5-6% growth on the month.
Yeah, roughly, yeah. So when you look at, say, aggressive or growth plus, you've seen very, very strong returns, which is great.
Good. And part of the diversification story, it's not just about equities. Bond markets are often overlooked because it's the equity markets that get the headlines. The news flow is all about equities, but bonds have got a crucial part to play in this. And Paul, on from your point of view, there's a couple of things happening in the bond markets which are really interesting at the moment. You've got the European situation and you've got new issuance. Can you tell everybody a little bit more about those 2 points, please?
Yeah, I think bonds have been very interesting over the past couple of months. I suppose if you've got your sovereign bonds, which get a lot of attention, so your UK gilts, your US treasuries, but the more interesting area for us over the past month or two has been the corporate bond market. What you've seen there is a real game changer from the Federal Reserve. Around March time, what you saw is spreads. So this is credit spreads, which is the premium investors require for the credit risk. You saw credit spreads really blow out as equity markets sold off in the wake of the coronavirus. But since then, the Federal Reserve stepped in and expanded their asset purchasing program to incorporate investment grade corporate bonds. And they also included a term called fallen angels, so investment grade credit, which has been downgraded into high yield. So what you've seen since then is spreads come in and investors being rewarded if you've owned those assets. So for growth aligned, we've been increasing our exposure to corporate bonds, and we've done that in twofold. We've done it via a passive strategy, which is just buying US investment grade, and we've done it by a new active manager from Allianz. We believe in this environment, it's good to have some passive, but also good to have some active. Having a blend of both gives you a good risk-adjusted return. But having active management in the bond space, we believe is very important. Being able to have a manager that's got the skill to identify the good corporate bonds, the good bonds from the bad. So we've introduced a new manager over the past couple of weeks, and just looking at the performance of the 2 new holdings, they've done very, very well for us over a short period of time. What we really like about the new active manager that we brought in, they've got not only a great long-term track record, but they've managed this very volatile period very, very well. Providing good returns, but also providing excellent diversification. So it's been has a very low correlation to equities, which is exactly what we want. So we benefited from strong equity markets, strong bond markets, but also had that diversification, which is effectively giving you a really good risk-adjusted return.
I think that's the important point there to bring out a little bit, because selectivity and the ability of an active manager to be selective is crucial. And if we go back to what we discussed in some of the key themes from our meetings last month, what was crucial there was the ability to be selective, and that's what active gives us. And that's a really important point for us to draw out and think about that in the overall context of how we're delivering returns within TPP as well.
Yeah, and I think that the part of the story about the bond market is the terminology that Paul mentioned, investment grade there. You know, what is the significance of investment grade as a title, as a quality of an investment?
So investment grade is higher quality bonds. So that's the way I would think about it when you hear investment grade, higher quality issued debt.
I'm going to bring. Thanks, Paul. I'm going to bring Barney in a moment to talk about the UK, but I think that I don't want to leave the US and Europe quite yet, because on the bond side, you've seen some huge cash being raised here. In the US, I think we've seen over $1 trillion of bonds issued into the market in the last, say, 149 days, and this started mid-March with both it was ExxonMobil and Verizon who raised something like $12 billion in a day. In Europe, we're seeing the 750 billion euro issue, and Jeff, we were just talking about this yesterday. You know, it's coming from capital markets, but it's going to be distributed across European countries in a much different way from what we've seen in the past. Could you tell?
Yeah, I think that's right, and I think for me, yeah, I'm probably as skeptical as the next person on what's happened in Europe historically, and whether they can deliver on this package that they've set out to get through. Now, clearly there are likely to be challenges. Will be negotiation and horse trading around it. But I do find it interesting that the package has been structured in a way that is both loans and grants. And so 500, 250, sorry, the other way around, 500 in grants, 250 billion in loans, but that gives scope for trading within it. It's also set out, I think, quite neatly how the European Union think about potentially funding it over the next 40 to 50 years, which has never been part of the plans in the past. So if this does come off, or a version of it does come off, I think it is really important for us to think about what that does mean for Europe, what it means for the cohesiveness of Europe, and how Europe does appear to be wanting to potentially work together. So I think it's important. I think it's an important thing for us to challenge, and anybody to challenge their own long-held views, and that's what I suppose I'm doing with myself around it, because as I said at the start, I'm skeptical in Europe, but actually this could suggest something different. I think the other thing around that is just it speaks to one of Paul's points as well there about the issuance that we've seen. Issuance in investment grade in Europe has been pretty good as well. So we've seen corporate issuance across the globe at this point in time. When we think about where we were 2-3 months ago, these were markets that were completely closed. They weren't open, and it's an ironic situation where we've seen in the US market that 200 billion of IG investment grade credit issued per month since the crisis, or the nadir of the crisis on the 23rd of March. So big changes in fixed income markets across the piece over the past month, and Europe potentially as a sovereign entity joining that as well in the coming months, if we can get 27 to agree to some form of this plan.
Yeah, 27 to agree. That kind of leads us on to the next subject, really. Okay, let's turn our attention to the UK, because there's been some real significant developments here. Not least that we've lost Barney from the webcam, but you will be able to hear him speaking from Middle Northumberland. The internet connection must have gone for you at the moment, Barney. But despite the fact that you're closing down, it looks like the rest of the UK is starting to open up a little bit. From Monday in England, we'll be able to meet up to 6 people from different households in parks and private gardens. And you can actually walk through somebody's house to get into a private garden. Scotland, where Jeff is, up to 2 separate households can meet of up to 8 people. Wales from Monday, 2 different households. And Northern Ireland will be opening up a little bit further from the 8th of June. Now, shops opening, it's a significant start, I think, to a return to normality, which will take a little while. Barney, if we look at the UK, corporate UK, businesses in the UK, and how it will affect true potential portfolios, what are your thoughts on this as we do begin to open up a little bit more?
Morning, everybody. I think the government and governments around the world have got a very difficult decision to make. They're damned whatever they do. If they open up too quickly, then they get criticised for putting the population's health in jeopardy. If they remain locked down for too long, then they risk sort of, killing off the economy. It's a very difficult line they have to tread, and we're seeing governments around the world, but also within the UK, sort of treading quite lightly. They're all doing the same sort of thing, but in different ways. So instead of just meeting one person, now you can meet 2 people or up to 6 people. You can meet in public areas. I think, as you said, in England, you can go to somebody's garden. You can actually go into their house. In Scotland, you can't even go into the house, not even to use the loo. So I don't know what that might say about the state of Scottish lavatorial facilities. Jeff, perhaps you can sort of shed some light on that. But later in the call, I don't know. But the message is broadly the same, across the UK and at different stages around the world. That we are seeing a gradual opening up. And although, there have been a lot of parallels drawn between this downturn and the last one, the global financial crisis in 2008, 2009. And while there are parallels, especially in some of the data coming out, we've seen it's been the worst increase in unemployment since then. It's been the worst sort of fall off in GDP and economic production since then. This one is very different. This one is not part of the economic cycle. There haven't been generally recessions happen. There are different catalysts, but it all revolves around an overabundance of debt, borrowing by consumers or companies or both, resulting in a weakness in the banking sector, which brings about financial collapse. That's not the case this time. There is an overabundance of debt, but it's concentrated in countries at government level, which, and for the most part, those countries can ultimately print money to get themselves out of the hole, which is what they're doing. This was not the inevitable consequence of imbalances built up in the global economy. This was just an accident that happened to everybody, it's a bit like a sort of car smash on the M6. It's a tragedy for those at the front end. There are umpteen other people caught up in the tailbacks on both sides who are just sitting there, who are affected by it. Now, the traffic is moving again slowly. The emergency services have been quick on the scene. They've taken the appropriate action or as best they can. Things are moving again. For some people, it will be life. Life will return to normal. They'll get to where they were going just a little bit later. Others will have missed things that can be postponed, rescheduled. They can pick up where they left off. It'll take them a little while to make up the lost time, but they'll get there. For other people, what they've missed, they will never be able to recapture. And I think, that's the same this time around. Unfortunately, there are some companies that will go out of business, some before they'd even started. There will be companies, we've seen the announcement from Rolls-Royce that several thousand people are going to be laid off. That is deep scarring that Rishi Sunak, the Chancellor, referred to. For others, it will be, it will be a gradual, but return to normality. And for others, it will be the same but different. What we've seen in some areas in our everyday life, certainly over the last 10 weeks, life has slowed down a lot. In other areas of life, we've seen a great acceleration in trends that were already underway. And that's going to be interesting to see how those play out. At the end of last year, we were looking at this sort of rapprochement and a more cordial relationships between the US and China. Now we're seeing a renewal of hostilities. We've got Trump's speech this afternoon, which unsettled the markets yesterday. We'll see what effect that has as we go into the weekend. But on the other side of things, we're seeing China playing a very interesting game as the US is sort of retrenching from its position or its traditional role as world leader. China is trying to sort of step into the breach that has created, step into that vacuum.
There's a fascinating race going to take place here between the US and China. This is which of the two superpowers finds a vaccine first. And, this is the equivalent of the moon race, isn't it? Modern times.
Yeah.
Chris, there's three areas I'd like to talk to you about, and the great opening up of the UK, things which are quite close to you. First of all, there is the opening up of the pubs, the public houses. You've then got the opening up of the gyms. And then when will you be able to go back and let your Turkish barber set fire to your ears?
Thank you, Mark. What a good question. So I watched a few videos. I think a few of them on BBC News, MSN News, and the first one looks at what could a gym look like when it reopens. And what they've actually done is they put perspex glass between each treadmill. So you've got a kind of 8-foot perspex glass to make sure that you don't spit on anyone or sweat pours up. Probably spit on someone's the wrong word, but so you don't, sweat doesn't come off you onto someone else. I think the other video is what you were saying around pubs, which I thought was really interesting because it was just completely different to what you have now. And that is, you've got an entrance and an exit, and you have to go through the entrance and you have to go through the exit. You can't mix the two up. As you go through the entrance, a person then takes you to the table. They then seat you. If you want a drink, you can either order it through an app or you order it with the person at the table. The person brings the drinks on a tray. They don't touch the glass in any way, and then they put it down. And also there was perspex between each of the different tables. So if you had a kind of booth, they put perspex covers between them, which again is very, very different to what we're used to now. But I suppose in some ways, that is how you have a socially distancing pub. If
it's an interesting one, Chris, isn't it, to think about what that means from a consumer's point of view, and whether the experience is the same, and whether psychologically you do want to go into that environment or not. And that, I suppose, that's the kind of great unknown as we approach lockdown, as to how these things will evolve and change, and how we think about that, and how everybody is thinking about that. What's the sort of the risk calculation that they're all doing in their own minds about, well, will I do it this week? Will I do it next week? Or will I go outside because I've been able to enjoy my time outside through this lockdown? And I was reading an article, was it yesterday, that the sales of bikes and bike related equipment have just went through the roof because people are doing so much more outdoor exercise, which might be the way forward as well.
Chris doesn't need to buy a bike, Jeff. He just acquires them.
We can't make jokes like that in this video.
It is interesting, though, that Chris has seen videos about the gyms and the pubs, because I was sent one by KLM last week, just to show how, if you were to start flying again, what the experience will be like. And it is very much used technology. You know, check in online, have your boarding card on your telephone. If you don't have that, check in at a perspex surrounded desk, which or machine, you know, the automated machines, which will be wiped down regularly. And then check your luggage in again, somebody behind a perspex screen there, and then face masks to be worn at all times, boarding the plane, etc. And it just reminded me that the travel industry was at the forefront of this, hit very, very quickly by lockdown across the world. You know, 150 million Chinese visitors overseas per year. Suddenly that stopped. Airlines are grounded. The cruise industry, interesting enough, you know, Carnival share prices bounced significantly. But the opening up of airports is an indicator of things, again, getting back to normal. You know, just locally, our flights will start from the airport in the middle of next week. Very slowly to begin with, but nonetheless, flights are beginning. And this could be a significant development that we see for everyone, not just for business travel, but for leisure travel as well.
I think for leisure, it's crucial. Again, it depends how the uptake of that will be. But if we think about, particularly for Europe, US, and some parts of Asia, where you've got economies that are very, very dependent, tourism and leisure activities are a large proportion of GDP. You think about, you know, Southern Europe in particular, 10 to 15% of GDP is related to tourism, hospitality, and leisure industries. So those are the economies that we need to see getting some form of assistance. And that's what the ECB package, I suppose, is aimed at, but also just that gradual opening up, as you say, for travel to come through, people to want to go back to traveling is crucial. And it's interesting that the airlines are trying to get in the front foot, use technology to suggest that. And I suppose there's two things there that we've been touching on. I think if we go right back to our very first or second podcast, we talked about China and the role that technology was playing there post our trip to China at the beginning of the year. If we look at the Asian markets that have been very forthright in dealing with COVID-19 tracking and tracing, how have they done it? They've used technology to achieve that. That's been allowing them to open up probably faster than what we've seen in European markets, and then particularly in the US, because they can track and trace really well. So that's something that I suppose speaks to how technology can help things evolve, heal, and deal with this situation. I think the other thing that we've touched on in our podcast as well that's related to airlines and airlines returning is just the oil market. And if we think about the importance of the airline industry overall from a demand perspective, you know, it's 8 to 12 million barrels a day is used through refineries to produce jet fuel. With that market in significant distress, it's easy to see why the oil market's got a problem as well, until you get that travel market coming back as well, or you get the aircraft market to come back. So it just, I suppose, serves to really demonstrate everything that we're aware of and has been a key theme of all of this, and alludes to a little bit about what Barney was saying about China and the US is globalization and supply trends, how those things evolve through this, and how globally connected we all are and have been, and whether that is challenged or changed in any shape or form by COVID-19.
Yeah, and again, locally, and I mentioned our airport here, another news item from yesterday was Nissan and Renault announcing some changes into their production line. So news of a closure in Spain, in Barcelona, which caused a little bit of civic or civil unrest, could be good news for the factory in the northeast of England as they move production of Renault models across into the UK. So time will tell how that one will pan out. I think also the airline industry is a classic supply and demand, very, very cutthroat. And at the moment, the supply is starting to come back. What we don't know is, will the demand be there?
Yeah.
And that, for me, is the big thing about all of this. And I think, Jeff, you touched on this, is, will people want to travel? Will people want to consume? How will their habits change as we move away from the coronavirus? It's something that we looked at for our Chart of the Week series. So we looked basically sit-in diners, so people dining in restaurants, and how that's changed year on year. Now, obviously, it's changed massively this year because we have a lockdown and restaurants are shut. But what happens as restaurants reopen? Do people immediately start going back to their favorite restaurant? Do they still go out for the same number of meals per month as they would have done previously? Or actually, is there now a change of habit? Are people actually maybe a little bit too frightened to go out initially, as they want to see how the virus spreads, if there is potential for some sort of second wave? So I think for me, the big thing there is really around consumption and how that moves as we move out of the coronavirus overall. Will people start to consume? Because that really is key for the economic recovery.
I think that's an interesting point to bring out. And I suppose, Paul, we've been hearing from a number of our managers about the importance of the US and the importance of US consumption and the US consumer. What are you thinking about that from a Growth Aligned perspective?
I think in the US, clearly, the consumer has been vital for their economy, and has really driven their economy over for a long time. And I think coming into the downturn and as the coronavirus spread, we continue to favour the US on the basis that the US consumer coming into this scenario was strong, and therefore arguably in a better position to be more resilient, and we've continued to favour the US on that basis.
It's interesting, I think, to look at the unemployment data in the US, where the approach really contrasts with what's happening in the UK, where the support package is very much from the government to support the structure of the economy and to maintain the functioning of business and keeping people employed. Whereas in the US, we've obviously seen that very, very, very significant spike up in unemployment. But then we saw the data yesterday where the continuing claims number was very different, in the fact that it went from 24.5, 24.9, I can't just remember the number, down to 21 million. So there's 3.9 million people who have potentially become re-employed in the past couple of weeks, which is quite a swift change. And if that trend is in any way sustained over the coming months, speaks to the points you're making there, Paul, around the resilience or the adaptability maybe of the US economy to change.
It's interesting because we were talking to one of our managers, SEI, a couple of months ago, and they were kind of very bullish around the recovery, and they were talking about the potential for US unemployment to be within single digits potentially as we move to the end of the year. So again, that sort of factors in with what you're saying there, Jeff, in the sense that actually, these unemployment figures can recover very quickly.
I think, Chris, that's right as well. And a lot of the managers that we have are looking at China as well and saying, right, they're going to be ahead of the rest of the world. We know why it started there, so they're going to be further ahead in terms of recovery. But when you look at the data on consumption of commodities, on raw materials, on the property markets within the big cities, say Shanghai, traffic levels, etc., there is a recovery. And if there's a model there to be followed, you've got real data, real facts which are coming out of the area that was affected first. and perhaps that could be significant for the rest of the world. And the US, the jobless figures, it's a result of probably lockdown being eased there, that people can get out more and they can go looking for work, and there are jobs to fill. And thinking about the UK, the restaurant chains that are there, the high street chains, they're opening up now for delivery services. Not much good for me where I am here, because I'm a little bit too far out of the city centre, but Paul can now get his deliveries again from Wagamama and from Nando's, being on the quayside in Newcastle. But Paul, before we start recording this, you were mentioning, just looking out of your window on the quayside, you can see some changes.
Absolutely, yeah. Behaviour has definitely changed, especially amongst the younger generation. You've seen a lot of people using any grass areas, any benches, just to enjoy the weather and have a couple of drinks that they've got from the supermarkets. And people are more willing to do that, and it's definitely changed. I don't know if it's the changes in the lockdown measures, whether it's the warm weather, but people are certainly, especially amongst the younger generation, prepared to go out and to socialise where they can.
I've noticed if I go for a walk, social distancing is still there. People will stop and move aside and move at least 2 meters away from you. So that message has got through. Track and trace, well, that's a can of worms, particularly as we talk in the UK at the moment, because we seem to be the only ones that can't get this to work. But let's hope that has an effect that everybody is looking for on that side of it. Looking at the week ahead, first of all, from the market point of view, from any data point of view, Jeff, what's coming? And then I'm going to ask each of you what you're going to be doing in the week ahead.
I think just looking to the week ahead from a markets point of view, I think the thing that I'm thinking about and looking towards is just to get PMI data from China over the weekend for May, and that speaks very much to that point, Mark, that you've been alluding to there. What does Asia give us a blueprint for to look at? The May data from China will either show us a continuation of that positive trend or a flatlining of the trend that we've been seeing from there. So that will be important, because what we did see initially was that improvement in the domestic economy, the domestic side of China, both in manufacturing and services. It's whether now that has been sustained or whether we see a bit of a dip, because internationally we're still only coming out of lockdown. So I think that will be something that we'll look to over the weekend to see what comes from that. And I think then the important thing probably starts to think around 2 or 3 things from my perspective. What does Mr. Trump say this afternoon about China? And what sort of reaction or non-reaction does that promote from the Chinese authorities? Now, clearly the past week has been dominated by the National People's Congress, and that set out an agenda that China wants to pursue, which interestingly did have comments around cooperation and things like that. So it's going to be an interesting dynamic. I think the other thing that's coming to the fore, obviously, is what the UK needs to achieve by the end of June with regard to the Brexit negotiations or non-negotiations that appear to be happening at this point in time. So news flow around that will likely be something that we'll continue to look at. And then, obviously, as we do consistently within TPP, engaging with their managers, hearing what they're doing, observing what changes they're making within the portfolios to get a sense of how they're positioning our portfolios for our clients going forward.
Lovely. Paul and Barney, the funds that you're managing, you're getting new money coming in each day. You've got what we term positive cash flow. You've got investment decisions to make on behalf of our investors. What are your thoughts on the coming week?
Yeah, I think it'll be interesting to see if we continue to see a broadening out of the markets as Chris and Jeff have touched on, whether we continue to see value to perform. We'll continue to add to investment grade corporate bonds, where we still think there's still money to be made there. We're speaking to a number of managers today and next week in terms of in the bond space, where we're looking at potentially looking at active emerging market debt managers, but also taking a look in high yield as well. And it'll be also interesting just to see how Europe plays out, and whether you continue to see strength in the euro, which has reached a 2-month high against the dollar, whether you see European banks continue to perform a little bit better, and whether you still continue to see a tightening of Italian bond spreads, which they have been doing on the back of this Eurozone recovery fund. So, as always, there's a lot to keep our attention high.
Okay, Barney, would you like to add to that?
Yeah, as Chris said at the top of the call, diversification remains key. We've seen a very strong rebound in the equity markets. At the beginning of lockdown, markets around the world fell by about 35%. We've seen a strong recovery since then. I think that the FTSE's up about 25% since the low point. The S&P is up 35% since its low point. So there has been a strong recovery, and that sort of speaks to the sort of slightly different nature of this downturn. This recession was induced by the lockdown, by the closing down of economies, by governments around the world. So its impact was much more sudden, much more severe than in any other previous downturn. But the stimulus and the support measures that we've talked about through the call have been put in place. They're now beginning to be felt, and we've already seen the response of equity markets to that. There will be hiccups along the way. There will be industries and companies that are never the same again. There is likely, as economies open up, there is likely to be, a reincidence or a second wave of COVID, but probably not as severe as the first. So the markets never go up in a completely straight line. But I think if we look out to the amount of support and stimulus that has been put in place, or the facilities that have been made available, all of that is very supportive for equity markets going forward. And
Chris, within the portfolios, as Barney said there, some industries will never be the same again. But what we employ our managers to do is to pick the winners and pick the areas of growth, and those areas that we feel will be right for clients invested in the portfolios going forward. What are your thoughts on the week ahead, and in particular how things will impact on the portfolios?
Yeah, sure. I think for me personally, the week ahead is really around manager engagement. So we're obviously restarting the month. So we restart our monthly cycle with the True Potential portfolios. So at this point, we're really preparing to speak to our managers to try and find out all of their thoughts around markets, and then how that then filters into their decision taking within the funds that they run for us. But I think you picked out a really good point there, Mark, which is the reality is we do pick our managers to pick out winners, and our managers are constantly looking to find those winners. They're constantly adapting the funds that they run for us here at True Potential to try and find where they believe is opportunity. And I think one of the big things for me is that there's always opportunity within multi-asset, because there are so many different choices that you can make, whether it be at an asset class level, a stock level, whether it be regionally. There's a huge amount of opportunity out there right now.
Okay. And looking at the weekend, Chris, on a different note, what have you got planned?
Unfortunately, my girlfriend Maura broke her ankle, so I will be looking after her, making her lots of cups of coffee and food and things like that. Also, the pub that is quite close to me now does takeaway pints, so I was contemplating going in and having some of them.
I think the decision had already been made, Chris. It wasn't contemplation at all.
No.
Barney, for yourself, what's planned?
Well, part of the reopening, we're allowed to go rowing again on the river, only in single boats, not in boats with a larger crew. But I'll be seeing this weekend if I can go out in a boat in a single, and remember how to do it and stay dry and not fall in. So that's what I'll be up to the weekend.
Great. Paul, you'll be looking for a little bit of greenery around the quayside, and you'll be sitting there?
No, of course.
Oh.
So it must have been at least 3-4 months since I had my haircut, so that's going to be the weekend's task for me.
Are you doing that, Paul, or is your girlfriend doing it? Are you doing it, or is your girlfriend doing it, or?
I'm trusting her to do it.
So we'll need a before and after shot for this.
Definitely.
I'll
Definitely.
get that through.
And Jeff, are you taking a break from homeschooling and Lego models being broken in temper and things like that?
Yes, well, we'll hopefully get outside in the good weather, or we will get outside. And given how lockdown has now been moved to the next phase in Scotland, we're going to try a socially distanced barbecue on Sunday in the garden. So that's going to be the plan.
Oh, great. Well, here the news of Premier League return in this household was greeted with a mixture of delight and despair. And I'll let you can guess who was delighted, and it was my wife Bev, who kind of held her head in her hands as the schedule was announced, which looks like it's wall-to-wall football. Matty was absolutely delighted. So I think that he's weaning himself back into football by watching Bundesliga. So hopefully we're going to all have a sunny weekend. We will be watching markets with interest in the coming weeks, days and weeks. All of the decisions we make are impartial in the portfolios. They're fact-based, which is really important for us. We position the portfolios for market conditions, as you will have learned from today, and we're taking active decisions each and every day within the funds and within the portfolios to position those for the future for everyone. So thank you, gentlemen, for joining us this morning. And most of all, thank you for watching this. And the True Potential Podcast 20 will be available next week. But enjoy this one, everybody, and have a super weekend. Thank you.
Thank you.
Thanks very much. Thank you.
Thank you.